Hi everyone, Jim of Dale Insurance. After a couple of very brutal years with respect to rate activity, premium increases throughout the industry, we're hopeful for 2026. Just as a quick, in case you haven't heard me before, pricing for insurance always lags by a year or two because it takes a little while for the experience to reach the pricing where they have to calculate pricings and generate pricing and then deliver it to the insurance departments to get it out there. So when the inflationary trends began, the increased inflationary trends began in 2022 and 2023, combined with the storm activity that we had in both of those years, and combined with the increased complexity of vehicles, so that what was a $3,000 or $4,000 claim to an auto policy to an auto before, in say a deer strike or a minor accident, became a $6,000, $7,000, $8,000 claim because of the complexity of the vehicles and the automation of the vehicles. So what we saw was just a general increase, a quick and general increase in the cost of paying claims. And the pricing that existed in 2021, 22, and 23 did not reflect the increased costs that were happening in 2022 and 2023. So basically, by the end of 2023, insurance companies had been dipping into their surplus, which is their savings account, the money that they have to hold back to pay for claims that could occur. And they were dipping into it at significant rates, not a little bit, but significant amounts, 10, 15%. And many of them were losing their financial ratings through AM Best, which means that AM Best was downgrading them from, say, an A+ to an A, or an A to an A- or something of that nature, because of the unprofitability within the industry, the loss of surplus within the industry, and the inadequacy of pricing throughout the industry. So what we saw in 2024 and 2025 was a correction to get to the pricing that is necessary to cover the increased cost of claims that have been happening through the storms, the increased cost of auto vehicles due to complexity, and then just the inflation that we saw, the back-to-back years of 22, 24, 25% inflation. Well, I think by all appearances, while we saw rate increases and rate adjustments taking place in the early part of 2025, we began to see them settle down in terms of companies taking that rate increase, because even though 2024 started off rough with some storms again, ultimately the storms did subside throughout the rest of 2025. Inflation has subsided. And so the pressure that companies were feeling, I think they began to feel release. And we just haven't seen quite a significant we just didn't see the rating changes in the activity that we saw previously. And so as most companies have finished out 2025, most are showing that they've either shown a modest profit or a modest loss, both of which are good harbingers for the prognosis of what's going to happen for us in 2026. We had a few companies that actually showed pretty good profit, but they tend to be overpriced. And I will also say quickly that the companies that were most competitively priced in 2022 and 2023, maybe even 2021, are those companies that were most significantly impacted and injured by the increased cost of claims. Companies that were either traditionally already too high, or in the season where just had pricing that was too high and wasn't competitive. Well, they didn't have quite as many what we would call unit counts. We didn't have as many, they weren't insuring as many homes, they weren't insuring as many autos because they weren't competitive. So when all of these increased claims costs occurred, it didn't so broadly impact them, and they were already overpriced. So those who were competitively priced have been more injured and have had to take more significant rating action than those who were high when it all began, for a variety of reasons, as I just discussed. But we're hopeful that 2026 will begin to settle down. Now, we need storms to continue to subside. We need inflation to stay at bay, and so we need good outcomes. We need good things to happen throughout 2026. But I think that the combination of rating actions that have been taken and the reduced storms and inflation will begin to show its impact in the companies returning to profitability, relaxing a little bit on their underwriting guidelines, because that's another thing that happened throughout 2024 and 2025 is that companies restricted their underwriting criteria and guidelines to really ridiculous levels. They were picking apart a home. We would write a home and they'd go out and inspect it and find a myriad of reasons why they didn't want to insure it. Well, that's not unusual in what we would call a hard market, tough times for insurance companies when they're not trying to write business or trying to return to profitability. But we're hopeful in 2026 that will begin to relax. The guidelines will begin to relax. Companies will become, they'll get into better moods than what they have been for the last 3 or 4 years and will be more compliant, just easier to work with. We'll see. Will we see if they've ultimately taken pricing beyond? I mean, if the storms don't continue and inflation don't continue, will the current pricing, basically amount to overpricing? We don't know. Really, time will tell us who's got the right pricing. There are a couple companies that have come in that were not competitive before, that have come in and appear to be trying to buy up business. Well, I suppose that's opportunistic, and we'll see if they're that much smarter than the rest of the industry or if they're just underpricing their product to buy market share and will ultimately pay the price, which they will pass along to insureds. So if they're underpriced now, they'll have to, as the losses come in and exceed the premiums that they've pulled in, then we'll just see if they can continue in their pricing strategies. So, in summary, let me just say we are hopeful for 2026, where we do monitor our renewals for our clients, trying to identify those who have had a percentage increase that's too high, and those who just from increases in the past just have premiums that might be higher than the marketplace would offer. We are trying to identify those, but we've grown to a pretty good sized agency now, and so it's not easy to do, but we are trying to do it. And now that if the rate increases will continue to subside, we will be able to more effectively, proactively market for people. But what we would like to say to people, what we would like to say to our clients is that we stand ready to help you, shop you out, and if you feel like the pricing that you have is too much, you're welcome to give us a call. Now, we always need to update our information because with time, the rating variables change, and we just need to make sure we're using current rating variables. So we would need you to let us know and help us update information. But we're happy to take a look at it. We would ask you not to do it every year because, things don't change that much every year, and it does. It's, to go shopping it could take half a day. So if we have too many of our clients asking for it, then, if we need to, we just have to get it done. But if too many are doing it for nominal reasons, then that becomes a problem. We'll become overwhelmed, and we'll have to find other ways to handle and manage things. So let us also say that this would be a good time to let you know that as with every renewal, as you get your renewal policies, please take a look at them. Make sure that the coverages and the information that you understand to be on your policy are current, especially for your auto policies. If we can't, in some of the forms and things that we do with people, we can't address every coverage for every vehicle because it can be coverage specific. Liability will follow every vehicle on the policy. Liability, uninsured, underinsured motorist, and medical payments coverage, which are the liability section of your policy, will apply to every vehicle on the policy. But what does not apply to every vehicle on the policy is your full coverage, your what they call physical damage section of the policy, where you would have comprehensive and collision, potentially towing and rental reimbursement, and some other things that you might have like loan gap coverage or other types of coverages that may also be on the policy. So if you're expecting to have full coverage, make sure you're seeing that where it's talking about comprehensive and collision, you see a premium charged for the vehicle you think you have that coverage on. So just make sure that the policy has the coverages you need. Call us if you're not sure. And then also, if some of the rating variables on auto insurance is driving distance to work. If you've changed jobs and you've reduced mileage to and from work, then you can give us a call and we'll make changes to that variable in your rating promulgation. If a vehicle has lost value, if it's decreased in market value to the point where you just don't want to carry comprehensive and collision coverage on it anymore, because if you're paying $300, for a vehicle that's worth $2,000 and you got a $500 deductible, you're probably not winning there. It's probably a good time to start dropping the comprehensive and collision coverage. But that's more, although age impacts, of course, the market value of a vehicle, age is not the sole determinant. For instance, trucks, hold value forever. Some vehicles lose value more quickly. So really, as you make your determination as to whether or not you would want to keep or drop comprehensive and collision coverages, you might want to do something. Go to NADA guides or Kelley Blue Book or Edmunds.com and look into the current market value of your vehicle to get an idea of how it would settle out in a claim. You'll never get the full retail value, but you should get something better than the private sale value. So somewhere between the private sale and the retail value would be a reasonable representation of how your car might settle out in a claim, because basically they usually these days will settle out for average retail of vehicles similar to your vehicle, average retail on the lots. So, and on your, also keep in mind that you can always increase deductibles. If you've got a $500 deductible and want to look at a $1,000 deductible on your auto insurance, okay. Might be something to save money on your home insurance. If you've got a $1,000 deductible, deductibles, some companies are offering are mandating minimum deductibles of $2,000 and $2,500. But increased deductibles might be a way of saving money if you can absorb increased deductibles. And there might be some coverages that you valued on your home insurance in the past that with the increased pricing of home insurance in recent years, maybe it's just not something you want to continue to invest in or purchase. So there might be some coverages that you've purchased in the past and found value in at the price that they were offered that you may want to do without these days. So I guess what we're saying is, if you want to evaluate your coverages, please take a look at your policy, and then if you want to give us a call to check it out and discuss it, give us a call and press 1 for the service team, and anybody would be able to help you go through your policy and make sure that the coverages you have are the coverages that you still value and are current. With that, we are hopeful for a successful 2026 for you and for us. We, as always, welcome your calls and your feedback, and we so much appreciate being given the opportunity to serve you as your agents. And we hope that we have done a good job and that we continue to do a good job. We want to bring the best value we can to our clients, which involves great pricing, great service, the best we can offer. And we always want to be putting our best foot forward. Thank you.